Okay, guys, hopefully you guys can hear me. I'm just going to get a quick sound check again, and then I'll get started on today's topic.
The broadcast is now starting.
Okay, guys, it's David here from Admiral Markets. Just doing a quick sound check to see if you guys can actually hear me so I can get started on tonight's webinar. Give me a couple of seconds. Okay, great, guys. Sorry for the wait. I just had to fill in a few things in here. I'm going to get started and get straight into it today. So, look, today's webinar is going to be something a little bit different. I've been going over live trading and obviously how, the things that the concepts that I bring in and things like that. It's very hard to these days, go through the nitty-gritty of everything that a trader looks at. I'm sure with your own trading, us as traders, we've developed things that we don't even think that we even look at these days, but they really do actually help you in your trading. So obviously I'm basically a price action trader. So when people talk about price action, it's not just about the candles going and making chart patterns form and things like that. It's understanding the anatomy of how actually the trading market works and how the currency markets or any markets works. And this is the great thing about technical analysis and obviously price action trading. It doesn't matter what you're trading, there will be some form of element towards the actual price action side of things. Now, basically, obviously today's is going to be on liquidity gaps in Forex. This is very instrumental in my trading and very instrumental to a lot of traders out there who do trade price action. It may be something that you have not heard of before, but it's something that the thing that I like to teach in here, or at least go through with you guys, is I like to show you things of value, things that actually help my trading, and not only my trading, but a lot of what the big boys out there are actually watching, from your bank traders to institutions and large traders as well. Things that I've picked up over the years and things that I sometimes forego as important because, like I said, it's embedded in my anatomy now to when I trade. It's pretty much the first thing I look at when I go from a top-down perspective. Very important for you guys, new traders out there, to understand the basis of price action and what does it mean by liquidity gaps. So like I said, I'm going to show you some things of value and what I find most important, the tools that I use when I'm looking at setting up my charts for the day, so I can get my day underway and know, okay, well, this is what I need to, this sort of level here is what I need to stay away from, and this sort of level is where I've been looking to trade as well. Like I said, the best part about what I try to show in these webinars is simple things that you can actually go and take on without having to have a quantum analyst type of experience to be able to look at markets or trading. That's a great thing about, obviously looking at price action trading. And this will probably help for today. Hopefully, if you guys have seen this before, it won't be too boring. But if you haven't seen it before, it's definitely a good thing for you to explore on your own and just go back on charts and just find out what I'm talking about as well. So before I get going, obviously I have to go to the next slide, which is basically my general advice warning. Obviously here at Admiral Markets, I'll just read through this as quick as possible, then I'll go and slow myself back down so we can get started on the important stuff. Obviously Admiral Markets is regulated in Australia by ASIC. Before using Admiral products or services, please refer to the PDS, Financial Services Guide, and Terms and Conditions. Any information contained in this presentation, including news, research, examples, prices, commentary, does not constitute financial advice. This context is provided for the purpose of assisting traders to make an independent judgment and is subject to change at time without notice. Admiral is not liable for any loss or damage, including without limitation any loss or profit, which may arise directly or indirectly from the use of reliance on such information. With the risk disclosure, trading foreign exchange carries a high level of risk and may not be suitable for all investors. The high degree of leverage available can magnify profits as well as losses. You can lose more than your initial deposit. Before trading, please carefully consider the risks and inherent costs and seeking independent advice as required. There is also risk associated with online trading, including but not limited to hardware or software failures and disruptions to communication systems and internet connectivity. Admiral utilizes numerous backup systems and procedures to minimize such risks and reduce the duration and severity of any disruptions and failures. Admiral is not liable for any loss or damage, including without limitation or any loss or profit, which may arise directly or indirectly as a result of failures, disruptions, or delays. Okay, big breath. Let me close this down. Okay, I've got on here my old friend, the good old Paint, that you can find on any computer, and I wanted to utilize this to be able to show people from, some basic way of explaining gap analysis or liquidity gaps in looking at price action. What is a liquidity gap? So first of all, understanding Forex gaps is important because, like I said, they aid me heavily in knowing, good entries and also when to not take trades. Liquidity gaps, with them, obviously they're used time and time again. I'm going to explain what they are. I'm going to show you on the charts how you find them and exactly where they are. You see them every day, all day on your charts. Like I said, they're a really good tool to know, when spikes do occur. Well, when do I get in on a trade? Because a lot of traders, when they begin, they see a news announcement come out and they just go long when the thing goes up. Little do they realize as soon as they've pushed the button, the price just reverses on them and comes all the way back. It's called filling of the gap and things like that. I'm going to explain it because it's very important, even as a beginner trader, to understand what to keep an eye out for and what not to. What are they? So basically, like I said, these liquidity gaps are heavily monitored. Basically what it is, let me expand this out and I'll just use my drawing tool. So look, I didn't do well at art school, so hopefully this is as good as it comes. But basically what it is, price, we all know, goes up and then down, pretty much forming a range. So if I just start drawing, this is basically price. Obviously this is not candles, I'm just using a line here. Price will go obviously back and forth in a range till a new form of what is it we call it in terms of momentum, or a new breakout, some type of news announcement, or flows from the interbank market, or institutions come into the market and push the price up and down depending on supply and demand. Okay? The great thing about trading currencies is that it is very technically based, because we do have minimal gaps in regards to the share market, where from day to day, Monday through to Friday, there's a new start of the day and there's a new end of the day. So whatever happens overnight, or the Dow, the next day's trading can start, from any direction. And literally, these gaps do form. Now, the great thing with currency trading, especially if you're a technical price action trader, is that the liquidity gaps really only happen between the Friday to Sunday movement, which is where you actually see sometimes a physical gap in the market. Now, what I'm referring to is actual volatility, like liquidity gaps. When I mean gap, I don't actually mean a gap where there's no price. I mean a liquidity movement in price, basically a long-ended candle that's moved in one direction, basically from a news announcement, like I said, some flows coming into the market. It's what's driving the price in a direction. Great if you're on the side that you're trading and it goes with, not so great if you're on the other end of it. But a lot of people, when they begin trading, they look for these news announcements and they just think, if it's going up, God, I'm going to get into the trade. One of the things I don't do when I trade currencies is, and I've learnt the hard way when I first started, but now, is never to trace price. Price has to come to me. If it doesn't come to me, then I'm not going to take the trade, because you know who's going to win? It's not going to be me. The market will always win in that regard. The good thing about being a price action trader is that you can utilize the market movements by what's happening on the chart and take an advantage of it in the marketplace within relative, risk averse type of movements or anything like that. So let me just explain the liquidity gaps I'm talking about. So price, obviously, I've just gone up and down, up and down. Let's say a news announcement comes out and price spikes up and up and up and up and up, gets to a point. Well, now, basically, this is a line here, pretty much of support and resistance. Okay? This is basically where we're looking at price to come back down, because we may have seen it come down here, then shoot up. But basically, what I'm looking for is that initial drive up into the market or down. It doesn't really matter. When price is going up, okay, what a liquidity gap basically means, or what you're looking for, is basically to know that when prices do move in a formation in a certain direction from liquidity, there's a lot of momentum. There's buyers coming in here, buyers coming in here, buyers again here, and then here. It's not that they're basically outweighing the sellers in the marketplace. So there's reference point, and reference points are basically getting hit and hit and hit. So there's no really of this happening where price goes up and then down. It's moving in one direction and one direction only. So when do we know when it's going to stop? Or when do we know when it's time to maybe look at it coming back into the range? That all comes down to, obviously, price action and things like that. Let me go back on that. Oh, that worked. Okay, so when we got a price liquidity slip, or a movement in price action here, what it usually states is, look, gaps in the markets of FX, and in any other market really the same thing applies. Price usually ends up filling at some stage. This whole movement here is now illiquid, because only was buys in here, buys in here. Now, eventually there's an imbalance in price. What I mean by an imbalance is that there's a lot of momentum pushing one way. Price needs to rebalance itself. The way it does that is by filling this gap slowly. So whether or not it starts to form and develop a range here, slowly breaks down that range to the next level, retests, maybe breaks down to the next level, so on and so forth. And sometimes the good thing about liquidity gaps that happen in a straight line, you will find it fill quite quickly sometimes, depending on time of day and thing that's happened, right down to the point of origin, right where the actual move got taken place, right across here, where here is where a fill of the gap occurs. Now, two things that I take away from this is a place to enter the trade and a place to know that if I'm long after this move, I need to really consider whether or not I can see price formulating a specific part of support and resistance, because if it does and starts breaking down, there's a good chance it's going to fill the complete gap. So if I'm long up here, I'm thinking, hang on, now this could be a move, because the likelihood of it filling is going to be probably more probability than in price continuation. Okay, so it's one of those things that I always keep a lookout for, keeping into understanding and looking at charts, hourly charts, 4-hour charts, 15-minute charts. It doesn't matter what time frame. It's all relation to synergy. What's all relation to what's called fractals in trading. Let's not go over what that is, but it basically means whatever happens on a high time frame can happen on a small time frame. Something that looks like on a 1-minute chart could look exactly the same as a daily chart. It's just a difference in time frame. So liquidity gaps happen on every time frame. You'll see them on every time frame. I'm going to go through and show you a lot of examples on the charts. Now, another thing is that when you're looking for a good trade, basically one of the trades that obviously dealing in the direction of the trend, obviously if price is moving and trending upwards, I have a liquidity gap here, big spike movement, starts breaking down and filling the gap. Taking a trade here, obviously utilizing time of day, obviously utilizing other areas of support and resistance, obviously using maybe Fibonacci, anything that you'd like to obviously utilize trading as a high probability place of entry. This area here, coming back to refill the gap from where the price spike occurred, is sometimes a really good place to set a trade going long as well, because it's moved up a momentum, price is filling the gap, rebalancing the market, and coming to the point of basically where the move occurred. The base of where this occurred is sometimes a really good entry to go, obviously, in the direction of the trend. So if this came from a market from down here all the way up, sideways, up again, fills the gap, this is excuse me, this area here can be a really good point of reference to actually trade along with. Same thing in short as well. So hopefully that sort of makes a bit of a dynamic in what I'm talking about. And I want you at the end of this to go through back to your charts and draw these, well, not draw them, but draw with horizontal lines across your chart where these are occurring on a daily basis, or on an hourly basis, on a 15-minute, 5-minute basis. I obviously trade predominantly more on looking at your 15 to 5-minute, but I'd at least reference the 1-hour chart and have a look at the gaps on the chart to see, obviously if I'm looking for specific trades, I want to know, am I trading, is the general consensus going to be filling the gap, or is the general consensus going to be bouncing off a gap? Things like that. So I'll close this down and push it to one side. Now, I've drawn a few lines over here to basically go through some examples for you. But what we're looking for is basically this. It's simple. Let me fatten up these candles for you. When you're looking at gap analysis, or when you're looking at liquidity gaps in the currency markets, you're looking for these candles here, the long candles in one direction where there isn't this type of formation. Price comes up, price comes down, price comes up, price comes down. What they're actually doing is filling each other's own fluidity. It's what's called a fluid market. It's a nice market to trade because there's no news announcements, but basically when you see a direction move without basically it coming to fill, at least to come back down to fill that candle there, that's what causes these liquidity gaps. From when I look at this trade over here, price is moving in sideways, gets momentum, starts shooting. It's actually started from here, but we do have a lot of cross follow through behind it. Start moving up from here. price starts to consolidate, it doesn't actually come back down to the point of origin. This is the point of origin that I'm talking about here. This is important because you actually want to keep an eye out for this point of origin in the future or in the past. Now that I've created that, I want to look, okay, now remember, this is coming from a momentum base. It's coming from down here. So price is sort of trending. This is a 15-minute chart. Yes, I do understand that. But remember, price is still coming from below and forming at least a bit of a trend to the upside. So looking for a long where this line or this price starter, or even this one here, could be a good entry point to actually look at your trade. And this is literally on the Euro USD 15-minute chart, and obviously this is priced right now, so it wasn't too long ago. It was obviously probably Thursday or Friday last week. But basically, let's bring this up. Let me fatten this for you guys over on the webinar. Why this is important, because it actually can give you a lot of help with your trading, learning where good places are of entry, but also obviously keeping in mind, you know, we're looking at trend here. Trend is forming from down and going to up. We have a spike up here. Something obviously occurred around here that's formed the spike to move in this general direction. This is Euro USD. If I look at roughly where this origin took off from, is 130.83, came up to 131. 13, so that's probably around, you know, 30-40 pips. So 30-40 pips is kind of, you know, it's not a big deal, but it's enough to actually, okay, there was a bit of illiquidity here, not price rebalancing. Price has moved up straight and away, but it keeps on, it starts trending. But see, this is nice here. Price comes up, fills. Prices goes up, fills. Prices up, fills. Prices up, fills. Prices up, fills. Starts to create an apex here. What I mean by an apex is that it starts to actually formulate price here that's forming a like section here, a bit of a peak, or what's called an apex. As you can see, a V shape. There's the, ooh, what's that? Excuse me. Here's the V shape right now. Bit of an apex forming. Okay, price breaks down and starts trading beneath this line. Well, if you're an actual price action trader, this could be a good entry for you to be looking at coming back down to this and filling this gap. This isn't the best example because it's actually filled in quite nicely here. So that's why this came down and didn't really fill very quickly. But let me get rid of this and these two. Look what happened over here. This is obviously a bit of nice support and resistance. Price spiked down. Came right down to where? Came right down to the point of origin, which is over here from this little checkpoint. Oops. There we go. That took off from there. Came down, rejected. Look at these wicks. Rejection, giving you hint. This can actually start as an acting. This is an actual acting point for you to be looking at a long trade. Okay. Now the reason why it's more probability bouncing off from here is the simple fact is we know to the left of us it's formulating a bit of a trend, an uptrend. So that's why when it fills, you know, the probability of it actually bouncing up is even higher now. Now you can use Fibonacci as well if you wanted to. Sometimes I would, sometimes I wouldn't, depending on what I'm looking at. But that pretty much falls in line with the 50% retracement to the pip as well. So there you go. That's a bit of extra momentum for yourselves to actually looking at, you know, this from a point of view of taking trades going long. Now I've drawn this one down here as well because that's actually where the price actually started to move. Let me just thicken up that line for you. And what happened here when it finally broke down, and remember, look, this is another gap here. I'll remove this line. Do you see this candle, this red long candle? Let me fatten it up for you. This red long candle here I'm looking at, okay? I don't know how to draw circles or anything like that. It moved sharply down, okay? Now, when that hit our long entry point here, look what happened. This got filled incredibly fast. As soon as it came down, it filled this gap right up to the point of origin, which is basically around here, very, very quickly, okay? Now that alone, that move is probably not huge, but we're looking at around 131.04 to 131.38. Well, actually, it's like 34 pips just in that alone. Now, that's good. I look for this trade because not only do we have the point of origin here, ready for our long here, which I'm going to move that tick over here, but because it moved sharply down, the likelihood of this filling quick, and look, don't get me wrong, I prefer to hit my 10, 20 or 30 pip mark quicker than possible. This helped it so much more because it moved down sharply to the point of origin of this trade, broke down and moved straight back up and filled this illiquidity right here straight up in my trade. That's 30 pips on that trade alone before you're coming out. I wouldn't have taken it out up here. I would have gone out around here, around the point of origin, if this is the trade that I took. Okay, let me remove these lines because I want to actually show you the next line down. Get rid of that. Let me minimize it a bit so we can focus on what we're talking about here. Okay, now, price actually started from this point here. As you can see, there are all these wicks. This long candle started from here. Now the move, I mentioned when we got to the first one where we took off from here, eventually filled that and came out to the second one. Again, another entry to look be going long, to the pip actually, and this is Euro USD on a 15-minute chart, okay? Moves up. Okay, now I'm not talking about this from taking trades. I want you to look and study this because it is a really good tool and you'll find them all over your charts each and every single day, especially around things where, you know, they're highly liquid markets or illiquid markets. Remember, a price movement like this only occurs when there's momentum shift and there is a change in the dynamics of the actual market sentiment at the time. Flows are coming through to actually, you know, whatever these flows are coming from an institutional point of view, moving the markets, news announcements, anything like that. Once again, look, basically the point of origin, price moved sharply and then moved up sharply again, starts to reject, starts to break down. Let me just get a little pen. I'll try and find you. It's all over your charts, but I haven't had a lot of time to go over a couple of them, but these will really sort of help. Come on. Why are you not dragging? Give me a moment. I want to explain this over and over again so you guys get it because it actually really is helpful. It's not being friendly today. Okay, why are you doing that? I don't know what's going on in my charts. That's okay. I'll use these ones. Let me delete these off. Clean it up a bit. Okay. So again, once again, we have spike up coming back down to the origins. Same thing with here. We had price. Let me move this one. Get out of the way. With a sharp spike down, price fills the gap quickly. Spike up from here. Spike up, fills, didn't get to the point of origin, but tried to very, very close. Moved up again. Okay? Let me move these off and we'll go hunting for more. I'll put a few down just to make life a bit quicker. Like I said, today's webinar, and like most of my webinars, I don't want them going so long where you're getting, you know, bored over it. I want to show you some really good, useful information, and then you can go off and actually go searching yourself. So I'll bring this over here. Let's see if we find some more. Okay, here's another one. Let me fatten up the candles for us over here. Okay, price obviously was moving down in a downtrend, 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 downtrend. Obviously, this is a reference point somewhere in the future. Okay, but downtrend, downtrend, spike, big spike here. Don't know what it was. Basically, from around 1.2881 down to all the way down to 1.2813, which is around 70 pip move on that alone. Okay, this is when we start to look. Okay, we've got a price spike now. If I'm looking to go short from here and I start seeing a breakdown, this is what I mean by you keeping a good close eye to seeing whether or not this trade is actually going to move against me or not. Because if it is going to move against me, I'm going to cut my trade short. Okay? If it keeps on moving in my favor, excellent. I know it's a downtrend, so I'm happy to take a down trade. But if I'm looking for a down trade, I'm waiting for this gap to get filled. Okay? This spike has moved down. It's left the market inefficient. So now we're looking for this to fill, and how it does fill, it fills not too, depending on the time of day, it can fill quite fast. But price is broken down here. This is obviously a 15-minute chart. If I bring this down to the 1 hour, it even look more chunkier in terms of the actual price anatomy. But price breaks through this horizontal bit of line here, starts trading above, fills halfway, comes down, eventually fills right to the point of origin again. right to the point. If you took a sell from here, we were in a downtrend, so it actually was more beneficial for us. If we took that trade there, basically we look at it move down, down, down. For the first move alone, you're looking at around, like I said, 128. Let's call it 128.81 down to 128.46. That move alone from here to here is at least 35 to 40 pips alone. Obviously, the price came up, broke through the actual point, but it doesn't matter. We don't take it the second time. It's only good. It usually is good the first time only. Obviously, price kept on moving down later on. Okay, but that's just another example to the pip, basically, of where it actually goes. You'll find these all over your charts, like I said, even around here. Obviously, price started from here, but there's a lot of support and resistance on these areas, so sometimes I take it a bit above, the line to go here. But basically, we'll keep going down. Looking at price spikes and things like that. Price down here moved. It basically took off from about here, almost filled the gap to the point, and just kept on going in a direction. Obviously, that's not something that filled just then, but perfect example right here. Price took off from this point, boom, straight up. Started to fill the gap. Tries to basically the highs. This obviously is not created, so that's what it would look like in real time. But basically, price spiked up and started to fill that gap. Look at this once right here. It filled it in literally in a 50-minute candle. Look at the speed of that. That filled it right to the point of origin, looking for obviously a long. It came from a bit of a down market to an up market, moved up, filled the point right to the point of origin, moved up again. These are useful, I'm telling you. This is something that is worthwhile for you to know, because people basically trade this solely alone. There's a lot of stuff on the internet about it. There's a lot of stuff from people you can learn from this, but basically it's very useful to actually know and find out, because it can help a lot in your trading, especially knowing when to keep out of trades and when not to keep out of trades. Here again, I'll use this red line. Price basically took off from around here, spiked up, filled the gap right to the point. Okay, and let me see if there's other ones. If I'm looking, that's Euro USD on the 15-minute chart. Let me look at Euro Yen. Okay, there's a few here that I found as well. Okay, not to confuse the situation, let me clean this up as nice as possible so you can all see what I'm looking at. Let me make them bigger. Like I said, I'm going to try and keep it as minimal today, but I want to give you like a real heads up with some really useful information that you can go off and actually utilize and see it for yourself. It's good to understand what these things and why the market moves in certain things. There's always a technical aspect to trading. It's just half the time people don't see it, so they just think that it's candles on a chart. But there's always, in some respect, whenever there's a price spike, why it comes to an end at a certain spot will usually be an area of support and resistance back in the past, or a trend line that hasn't been seen by your naked eyes, things like that. So this is incredibly important to actually break through, because it really does help people's trading. Here's just one. Obviously, you can see a spike in price come down, comes up to fill the gap. Didn't get it the first time. It actually came to this point. Hang on. Actually came right up to this point here. Basically, that area of support, and that's a reference point there on price. Okay, but still, this is where the price sort of took off from, but where it was alone by itself. Came back right up to that area for a short. On the Euro Yen on this, obviously we're looking for a lot more pips on this because it moves a lot more faster. It's 130 around, let's say 130.50 down to 128.03. That's a lot of pips. 128, that's like 130 pips on that move alone. Of course, you're not going to be getting all the actual profit on this, but the reality is it's talking about these type of markets that do occur. Price action is important. All these things are important for you to understand. And look, from liquidity to filling, look at even this one here. This gap that came down here, it filled pretty quick, but this caused a gap right here. Guess what happened when it filled that? Right to the point of origin over here for a trade between here and here. I mean, if you're looking at Euro Yen, that's a pretty sizable trade as well. If we're looking for a buy on 129.35 all the way up to 129.79, 129.80 basically. So we're looking at around 45 pips just on that little move alone. Yeah, this is an hourly chart on this one, just so people were questioning. I'm sorry that it's hard to communicate with you guys. I cannot see the chats, but like I said, this is recorded as well, so we can go over this. It's very important, like I said, to understand this stuff. Like, here's another one down here. This is where you can see price starting from here. I'm pointing with my pointer here. Hopefully it's caught up. Right on this spike up, price has moved up, started to break down, the quick and swift move right back up to the point of origin, which is around here. Obviously it has a bit of a drag, and then just moved up. I mean, that move alone is still, we're talking about probably 35, 40, 50 pips on that move alone. Like I said, this is just on euro yen. Now, they're all pretty much, going to be the same. Price come from here. Let me fatten this up. Okay, this is a beautiful one coming up that I'm about to show. I'm going to go through all three of these very quickly. Okay, start on the big one first. Here we have price coming from below up here. Boom, took price into one direction. Now this is an hourly chart, so this is quite a long candle here. Okay, obviously we can see illiquidity over here, and look how quickly it fills the gap. Okay, liquidity here, fills the gap, fills the gap, fills the gap. Filling the gap is important. It doesn't always fill, but that is going to be an extreme market where the market is moved in one direction and it's not going to stop. Okay, but looking at, for example, this line here, let me draw two little ticks so we know that or I'll draw arrows so we know what we're talking about. Arrow up and arrow up. Okay. Price is obviously formulating, it's going back and forth, nice liquidity, back and forth, nice range, moved in one direction, boom. Moved up again, moved up, started to come down. Obviously this move down has been filled up here with that line there. This move down, been filled. This move down, filled right to the point of origin. This move, now, here's this line that we have over in this corner over here on the left. We look far to the right. And this move came right down to it, almost to the pip, buy. That move alone, I don't even want to talk about it because I would be lying if I said I'd take that from right to the origin, 126.64 to the high of 131.07. Okay, now that's a huge move. Now, would I be taking, this is for more of my long-term strategies if I was going to be doing this type of stuff. The reality is I'm kept pretty busy with doing the intraday stuff on my 15-minute time frames and trend lines and things like that. But this stuff, it actually, it works very well. It's important to have this in your toolbox as a trader because you can definitely know when and where to actually utilize. Now, like I said, like with anything, it's worthwhile you looking at it. Don't just get in there and start trading this stuff. No. Look at it and understand the environment you're in. Understand price at the point of what you're doing. Understand trend lines. Use Fibonacci. I don't know if this is a Fibonacci level over here. Price actually moved from here. So no Fibonacci gives me that. So it's just one of those, another thing that we can look at to get confluence. This time there wasn't a Fibonacci. But like I said, you look at the price spikes and you look at the point of origins and the way they just come back up to fill gaps and things like that, it's amazing. It really is. Over here, price sort of has this consolidation, spikes down, tries to fill, almost filled on that one, and then starts to make its move short. It's not going to fill always to the point of, it depends on, obviously time of day, and you've got to pick your own poison sometimes of where you want to get in on these things. That wouldn't have been a trade, but it's good to understand from the point of, look, here we go again. Let me bring it over here. You're looking for these price spikes. Price started from here. Okay, let me do an arrow so we're all on the same page. We know what we're looking at. Arrow down. Okay, arrow down from that point. I'll wait till you see that on your charts. Hopefully you can see that now. Moved in one direction very quickly. Bang, bang. This is an hour time frame. Well, look what happens. Rejection starts to formulate a bit of an apex. Now you can be looking at this from an avenue of going long at this section, filling the gap. Now a lot of traders do that. This is illiquidity right here. Illiquidity. Here it's been nice liquidity because it's been back and forth and formed a bit of a range. This is the apex I was talking about. Again, another bit of a spike and a V-shaped pattern. Okay? Boom. And put this in here. just to keep up with you guys there. Okay, breaks down, trades above. Obviously, if you bring that down to your 50-minute or 5-minute time frame, you can probably see this this range a lot more easier to trade off if you were going to look for that long to fill this gap. It fills right to the top. A nice short for us right here. Bang, straight down. That's a number of pips right there alone. We're looking at around an entry of 132.47. Came all the way down to 130.71. I mean, you were looking at over 100 pips on that move alone. It came up again. Like I said, I don't take it the second time, but it worked to a T on this one. I would not be looking at that, so don't even just use it as coincidence there. Let me delete some things so we can keep on going. We can explore this all day. It's all over your charts and very, very, very important and useful to know in terms of currency trading. Even if you don't use technical analysis in your trading, very important because, like I said, they're everywhere on your charts and they're good to understand from your point of view as what is price telling me, what is price doing now, when's a good time for looking at areas of support and resistance. Here again, let me just put some arrows in here so we all know we're on the right page. Arrow up. And another arrow up. I'll wait till this catches up. There it is. Okay. We've had a price consolidation, bit of a trend line forming here. Price moved up above, traded above, retested, shot up. Nice move. Not too much liquidity. It's starting to get liquid now. It's forming a bit of an apex. Again, we can bring into our support and resistance there. Breaks down, fills this quick little gap here as much as it can. Comes back right down. See this spike, this red candle here, moves sharply. Let me bring this closer to you, sorry, so I can actually make sure you can see. This red candle here, obviously price has moved up from here on the left-hand side where this first arrow is, moved up, started to break down, back end retest of this trend line, starts coming down. This red candle here, this red candle has moved very quickly to fill that gap. That's illiquidity. It's filled it very quickly right to the point of origin. Your buy, if you were looking for a buy, I'm saying, would be around here. Your drawdown is for minimal pips for you to be making a move up. If we look at the pip calc on this, we're looking at 130.74 up to around here, which is 51 pips. Just on that little move there is 51 pips. And pretty much you're done in 2 hours on this one alone. Okay, it came shot up from the point of origin, breaking down, quick to fill this gap because this is the illiquidity point right here. This starts to get filling, you know, you start seeing overlapping. As soon as it moves past this point, shoots down right to the point of origin, looking for a buy, back up to here or wherever it was. Obviously that's support and resistance, that's where you'd be taking out your trade, that's where you'd be entering on there. Okay, back and forth, back and forth. Once again, we come down here, price moves, spikes down. Even from this point here to here, you're still looking at, that's 22 pips just in this little move right here. Came down to the origin, came up, came down, obviously moved in our favor, but the drawdown was too high on this one. But remember, you would have got in here and obviously would have been taken out before price moved down. Okay? Like I said, this is important stuff, folks, because this is going to help you out with your trading, especially if you guys are looking for entries short and long. Like I said, I could keep on going. Let's go for one more, and then I'll let you guys be tonight. Let me fatten this line up here so we can all see the same. Okay, voila. This is obviously still in your hour time frame on Euro Yen. Okay, price is consolidating. This is coming from a low. This is obviously an uptrending market. Prices come up, filled the gap to here. Let me grab that. Let me show you what I'm talking about. There's the gap. Filled that right to the point of origin. Explodes up. Starts here. This is the one I want to talk about, this red line. So let me get rid of this blue line. Give me a second. Okay, let's get back onto this. This red line is what I'm looking at. Let me forget the rest, so you're only looking at one thing. And I'm sure all by now we can all see what's going on. and what I'm about to say, but let's just go through it anyway. Here's the point of origin. Price spikes up. Spikes. I mean, no looking back. Up, up, starts being fluid, starts to get a bit of overlapping. Pretty much moves in a range. Okay? Starts to move higher, price comes back down, and starts to formulate its down pattern. When it comes down, we're looking for this point of origin to get hit. Here the point of origin gets hit pretty much on one spike through alone and starts trading for a buy here. Okay? Price has moved down. Let's just say, let me grab my crosshairs. So basically from where I would have entered at 130.12, price came down to 129.94. You definitely wouldn't have had a stop loss. You know, a stop loss for this type of trading would have been beneath the last swing low. Price moved up. We're taking a number here. We're not obviously going to be getting all 240 pips on this move, this is the move. It's 240 pips up. Now, like I said, this is an hour time frame. Lately I haven't been looking at my longer, this is not even longer term, this is still in and out intraday still, but it's a nice little way to actually trade the markets if you're looking at direction, you're looking at specifics of how to actually trade the markets. If I bring that up to the 4-hour chart, let me see something. No, I just wanted to see if that was going to help me. And it didn't. That's fine. So going back to this, like I said, price moves up, fills a gap, and fills a gap. The liquidity that I'm talking about filled very quickly, and the spike from that alone is you're still looking at about 80 pips within the hour. Okay, so that's what I'm obviously hoping to get through. Like I said, these gaps are heavily monitored. This is not mums and dads trading. This is what the big boys are doing and what the big boys are using. Okay, they keep an eye on this just like they keep an eye on intra-trend lines that I was talking to you about in my webinars 1 and 2. Okay, this is important for you to grasp because it actually does help the way that you can look at the markets. And like I said, if you know there's a gap here and I'm doing some type of price action trading or some type of strategy that I've been taught by crossovers and things like that, keep an eye out that this part here is a very good likelihood it's going to get filled. Okay, so that can keep you out of a bad trade, but also can get you into a nice trade. Okay, as well. Very important. Like I said, you'll see this time and time again. Have a start looking at it yourselves and seeing if you can see the things that most people do see. Again, reference this point down here. You can see a liquidity gap all the way down here and what happened in the future with it, if the price ever traded back down there. It didn't. So in the future, that could be a point of origin for a trade in the future. I've gone over about 45 minutes now, so guys, look, like I said, I don't want to bombard you and keep you on here for too long. I'm going to show you specific things that not only people at home, mums and dads use. This is more talking about institutional type of trading as well. This is what they heavily monitor, these levels and of areas of pretty much support and resistance on its own, but understanding, reactionary points, understanding when price takes off, what it means. When price gets a lot of buying interest, it doesn't mean that the sellers have taken over and started to sell it back down. No, it just means that the buyers have exhausted enough for the sellers to start moving the market back down. So important for you guys to understand, and pretty much it's the basis of price action trading as well. It's understanding the anatomy of moves and why they fill. Okay, so like I said, guys, I wanted to thank you very much for tonight's webinar. I hope you got a little bit of this to actually help with your trading as well. It's just another part of what I'm going to try and break down for you over the next couple of, I'm on every pretty much fortnight as well. But this is recorded as well, so like I said, if you need, if you would like to get recordings, I will put in an email. Hopefully you guys can see it. admiralmarkets.com.au. Hopefully you can all see that email address. It's basically for you guys. If you type in info, I-N-F-O, at admiralmarkets, all one word, .com.au, feel free to obviously ask for the recording of tonight's webinar on obviously gap analysis or liquidity gaps and things like that. I'll be happy to send that out. Like I said, thank you very much for attending, guys. I really do appreciate your time. And next week we'll hopefully get into a bit more, of the live trading sort of stuff. Have a good evening and good night.